Welcome to Illuminati Silver. We tell the truth about silver. Today is Tuesday the 14th of April 2020. And yesterday we published a video entitled Silver Purchase at £1.50 over spot. Really? How? Where we showed how we were able to obtain, admittedly a relatively small amount, of 999 silver coins at £1.50 or the equivalent of $1.90 over the spot price. Then on Sunday, we also published what appears to be a more popular video, to be fair, entitled Buffett Sells Shares. Is this a sign of worse things to come? Where we highlight that world-renowned investor and one of the richest men in the world, Warren Buffett, has recently begun to sell a small range of equities. And we ask the question, does he know something the rest of us do not? Or is he just adopting a degree of portfolio housekeeping? And we place links to both of these in the description box below. Now today we wish to continue a regular theme of ours, which is the advancement in gold prices. We've highlighted in a number of videos that it is both our contention and assessment that gold will continue to rise, albeit gradually, in price, and the 2020s will be the decade for precious metals, including both gold and silver. We have also proffered the argument that gold will lead and silver will follow. And it's now heartening to see that even the traditional pumpers are at last arguing this same case, rather than constantly bleating about $100 silver because the gold to silver ratio must revert back to 15-1. Now, we would like to quote the conclusion of last Saturday's Gold and Silver Weekly Update. This is how it went. So the next few weeks are indeed going to prove quite interesting for gold and silver. The risk of holding gold with 0% or sub-0% interest rates, as witnessed in much of the Western world, is very low, as there is no or little yield to compete. In addition, with rises of 5% to 10% in a day or week, makes gold and silver attractive to speculators and investors alike. The level of financial support being injected into the system by governments and central banks via money printing will eventually undermine those currencies and cause gold in particular to rise. With such high levels of unemployment now occurring, it's difficult to see an environment whereby all of these jobs will be reinstated, resulting in governments having to increase their expenditures further in terms of benefits. All of these situations are positive gold, which will drag up silver by its bootstraps too. Of course, when countries get back to work and start demanding silver again for their industrial applications, we shall see silver then come into its own, and it too will then rise independently again. Unquote. Well, at the time of producing this video, which is 11:45 GMT +1, gold is currently $1,720 an ounce, some $32 higher since last week's close, and silver stands at $15.54 an ounce, some 13 cents higher. The gold to silver ratio has lengthened again and is currently back to almost 111-1. It seems to flit between 110.5 to 111.5. The case for gold buying has been put forward again today by both Reuters and Bloomberg. And we shall now listen to what these articles have had to say on the matter. Reuters article, dated April 14th. Headline: Gold scales 7-year high on rising economic worries. Gold prices rose to a more than 7-year high on Tuesday on rising fears of a steeper economic downturn and amid massive liquidity measures by global central banks. Spot gold gained 0.6% to $1,724.72 per ounce by 8:04 GMT. having touched its highest since November 2012 at $1,726.85 earlier in the session. The concerns about the economic outlook are particularly supportive for gold. Liquidity from the Federal Reserve, combined with the background of lower interest rates, makes gold a much more attractive proposition, said Michael McCarthy, chief strategist at CMC Markets. But he warned that in the absence of new news, there could be modest pullbacks as investors and traders reposition themselves. Many countries and central banks have taken fiscal and monetary measures to prop up their economies. The Fed last week announced a $2.3 trillion stimulus package, while European Union finance ministers agreed on €500 billion worth of economic support. The Fed stimulus aimed at injecting liquidity into the US economy tended to weigh on the dollar, which makes gold relatively cheaper to buy, while lower interest rates reduce the opportunity cost of holding non-yielding bullion. A steep economic downturn and massive rescue spending will nearly quadruple the fiscal 2020 US budget deficit to a record $3.8 trillion, a staggering 18.7% of US economic output, a Washington-based watchdog group said on Monday. Meanwhile, the International Monetary Fund said it would provide debt relief to 25 member countries. On the technical front, spot gold may test a resistance at $1,739 per ounce, a break above which could lead to a gain at $1,767, according to Reuters technical analyst Wang Tao. Reflecting appetite for bullion, holdings in SPDR Gold Trust, the world's largest gold-backed exchange-traded fund, rose 1.6% to 1,009.70 tons on Monday, the highest since June 2013. Bloomberg article dated 14th of April by Ranjita Pakiam. Headline: Gold's powerful rally brings $1,800 into view. Bullion has soared as the outbreak tipped economies into recession and spurred central banks to launch huge stimulus. Since getting caught up in a wave of forced selling last month as equities sank, gold has staged a powerful recovery. That means futures are now nearing $1,800 an ounce after trading in the 1400s less than 4 weeks ago. Spreads over spot prices remain wide. Quote, "What's happening here is that the Fed is expanding its balance sheet, and every other central bank in the world is doing the same. What you're looking at is massive currency debasement in the long term. That's the major reason why gold is higher, and I would think that over the next few weeks or months, we're probably going to retest the high that we saw in 2011, unquote. This is according to Hans Goethe, founder and chief executive officer of HG Research. Gold traded on the COMEX in New York is up 16% this year, less than 10% below the record set in 2011. Banks, including UBS Group AG, have boosted price targets for the metal, making the case that easier monetary policy, other stimulus, and lower real interest rates will support gains. As earnings seasons kick off in earnest this week, investors will be looking to get a better sense of how bad the hit to profits has been and how this quarter will shape up. Futures climbed as much as 1.3% to $1,785 an ounce on the COMEX, the highest since October 2012. Spot gold was almost $60 cheaper an ounce, with a huge spread a feature of trading in recent weeks amid physical market disruption. Worldwide holdings in bullion-backed exchange-traded funds have ballooned to a record on rising demand, with investors seeking additional portfolio protection. On Monday, volumes in SPDR gold shares, the largest such fund, surged above 1,000 tons to the highest since mid-2013. End of article. So, the general consensus appears to be a continued rise in gold prices as nations undermine the value of their currencies. It certainly appears interesting that the dollar index, whilst a little weaker than last week, is still managing to hold above 99 and is currently 99.2. The technicals for gold are interesting too, especially as hedge funds have added to their long positions in futures and options, at least according to the COT report. We're now at 7-year highs in US dollar terms, and analysts see $1,791 as the next major resistance level. The reason being is that this represents the highs last seen in August 2012, with support levels at March highs of 1703 and the 10-day moving average of 1638 beneath it. To be fair, we continue to like gold, even at these levels. And whilst there can be short-term pullbacks, the fact that, as we've shown on previous podcasts, the investment managers and advisors are now at last advocating the case for some level of gold investment. And this will surely underpin what we are currently witnessing. Now, if equities fall further, and especially if they fell dramatically, we saw an average of just 1% fall in US equities yesterday, then this could provide an additional catalyst for gold's growth. Now, we're not advocates of $5,000 gold anytime soon, and we even believe and of the opinion, based on the assessments that we've done, that even $2,000 gold this year will struggle. It's not impossible, but we still find it difficult, even with the amount of stimulus, to see gold reach $2,000 in 2020. That doesn't mean, of course, we don't see it reaching that level in 21 or 22. However, our downside assessment is a maximum of $250 to $300, much depending on what happens to the dollar value. And you can assess for yourselves where you believe the upside could be. Thank you so much for listening. If you haven't already done so, please subscribe to this channel and press the bell sign so that you're notified of our videos as and when they're published. Also, on the Richard and Greg channel, we shall be publishing another video this evening. And again, if you haven't already done so, please kindly subscribe to that one too. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.